What if I told you that you could become your own banker? No more relying on traditional banks, no more losing money paying interest, and no more waiting for someone else to approve your financial goals. It's all possible with infinite banking, but it starts with whole life insurance. Infinite banking isn't just for the ultra wealthy, it's a strategy anyone can use to take control of their finances, building long term wealth, and to create a safety net for future opportunities or expenses. And the best part, your money works for you in multiple ways at the same time. In today's video, I'll break down how to set up your personal banking system using whole life insurance step by step. We'll cover how whole life works, what makes it different from other financial tools, and real examples of how you can use it to grow your wealth. Let's get started. First, we need to define what an infinite bank is in simple terms. It's a strategy that uses whole life insurance to create our own bank. So the reason why we use the life insurance chassis for what we're doing with infinite banking is it's going to offer us some key benefits. The first is going to be a tax-free growth, as the money inside of the account has already been taxed. So from that point forward, it does not get taxed anymore unless you do MEC. The next is going to be liquidity. This is one of the most important portions of an infinite bank, as the liquidity is what we want. We want to treat it like a bank. So if we need the money, we need to be able to get it now without any red tape on our finances. And the final one is being able to take control of our finances. That's one thing that infinite banking does very well. It allows us to take control of our finances so we can dictate where the money goes. But while we're using it, we are able to gain interest on the money while we are using it. First, let's kind of explain what a whole life insurance is in general terms so that you can understand why we use this type of product for the chassis of infinite banking. So the first one is going to be the premiums that you put into the policy. This is going to be how much money you do put into the policy, and it's going to adjust based on how much coverage you actually need, as well as what you're looking to do with the money. The next one is going to be the cash value. So this is going to be the biggest lever that we pull when we are creating an infinite bank. So the cash value you can dictate in certain life insurance policies where you can put more money to the cash value than what your base premium is. And that's how we're using it for infinite banking. We're maximizing the amount of money that goes into cash value and minimizing the amount that does go to the base insurance, so it behaves closer to you depositing your money into a bank. And so that way we're able to utilize that money faster. The next one is going to be, with all insurance policies, you do have a death benefit. In an infinite bank, it's going to have two components to it. The first one is exactly what it sounds like. It's going to be, if you die, it's going to pay a certain amount. And then the other way we look at the death benefit, it's kind of like a safety net. The death benefit is always going to be slightly higher than your cash value, which gives you guardrails when you are looking at infinite banking and you're taking out money. You're never going to be in a position where you're taking out more than what your death benefit is. The final one is very important when you're looking at these types of products. You need to go with a company that gives dividends. The dividends is going to be what helps us account for inflation. So as the company does well, we want to make sure that we have a company with a good track record of dividends. So as the company does well, that money goes back into our policy, giving us more cash value growth. So eventually we get more cash value growth per year than what we put in every single year. The next is going to be setting up your personal banking system. So first we need to find the right policy. So first we need to look and find an insurance carrier that's going to allow us to do what we're wanting to use this policy for. There's only about a handful of carriers in the country that will allow you to do this. So this isn't a type of product that you can just go and buy off the shelf. So when we look at policies and insurance carriers that we want to use for infinite banking, couple things we're looking for is mainly we want a mutual company with a strong record of paying dividends, because we want to ensure that the policy is going to be structured for high cash value growth. This is the biggest one because you need a carrier that's going to allow you to adjust your base premium and your paid up additions. The paid up additions is just a fancy word for how much money goes directly to cash value versus how much money is actually going to your base premium. So when we look at this stuff, we need to be able to build cash value. So cash value is going to take time to build up. And depending on how we're going to structure that policy, whether we want more going into cash value first, or if we're looking for more long-term growth, we probably want a little bit less going to cash value now and to be able to have it go later. So this is going to require you to kind of assess whether or not you have the discipline of paying a higher premium if you want that larger cash value, and to make sure that the policy is set up to do what you need to do. The next part is going to be to actually utilize your policy. So this is when we borrow against our cash value. So when I say borrow against cash value, what we're doing is we're taking a loan from the insurance carrier based on our cash value. And from the insurance carrier's perspective, you're taking a loan on your death benefit. So the reason why we're looking at a whole life is since it's based on your whole life, they know at some point they're going to have to pay the death benefit for that policy. So when we do it, we take the loan, that's tax-free, but the cash value in your account stays in place while you're using the money. So this is where you can actually utilize that money in order to get more money. The infinite banking method is meant to be a safe haven for your money and allow it to grow, while then you utilize the money in order to make more money. So let's talk about how we can actually use infinite banking, because a lot of people get this confused of how they want to actually use it. So there's a couple common ways that we do use infinite banking for most people. The first one is going to be your investments like real estate or business ventures. A lot of real estate investors will use these types of funds for down payments or stuff like that, because they can take that money, they utilize that money, and then say they're going to flip that property and make a higher ROI on it. They're going to use that money, but while they used it, they're still getting interest on the money that they're using. And then they just pay back whatever the interest is from the insurance carrier, which is typically going to be lower than any interest rate that they're getting from any sort of bank or anything like that. The next one is going to be debt repayment. So this is a really good one to use, is you can consolidate high interest loans. So the way people do this, I would always say consult somebody before you start doing this. But when you're looking at loan repayment, if you're making a minimum payment on debt, what you can then do is change where the money goes first. So if you're spending $1,000 in interest, if you are able to put that $1,000 in the infinite banking system first, at that point, when you do take that loan for the $1,000 to pay the interest, that money is in the infinite banking system or the life insurance cash value. So instead of having the $1,000 in interest go away forever, that money is going to continue to grow interest, and then you're just paying back that loan over time because it's typically at a much lower interest rate than what it is on, say, a credit card. So what will happen is over time, that $1,000 that you were paying, as you consolidate your debt lower and lower, then you just pay back the insurance carrier for the loan you took out, but you've gained interest on all those interest payments that you've paid over that entire time. It's not an overnight thing, but eventually you're going to get substantially more because you didn't lose the value of that money. You put it in a storage system, and then you use their money to make sure that you can get out of whatever you need. The next one is going to be major purchases. One of the most common ones is going to be paying for a car. The reason why buying a car with an infinite banking system works so well is a car itself is a depreciating asset. When you drive it off the lot, it's going to lose money. So what we do, instead of paying cash for a car or getting loans for a car where we're paying the bank interest, if we have enough cash value in the policy in order to pay for the car, we'll buy the car with the cash value in the policy. All while the money that we paid for the car, we're still going to gain interest on that over time. And then we'll pay ourselves back for the car itself like we would with a traditional loan from a bank. But what happens is by the time we pay the car off, we've recaptured all the interest that we would have paid to the bank, as well as we didn't lose the money on the depreciation of the car itself. And then after that, once you sell the car, then you actually have the car and you can make more money on the sale of the car. So it's a great way to utilize infinite banking, especially when it comes to paying for cars. And it also works very well if you need to do a home renovation or anything like that you would have to go get a traditional loan for. You can use this type of policy to recapture the interest on what you would have normally paid a bank. It allows your money to work in two places at once. The final part is just some common questions and concerns when it comes to infinite banking. So the first one is going to be, what if I can't pay back the loan? So typically with a insurance policy and a loan out on it, the loan is unstructured, as you don't have, it's not a 10-year loan or a 20-year loan. It's a loan based on your death benefit because the insurance carrier knows you're going to die at some point. So what happens is if you do have an outstanding loan at the time of your death, it actually just subtracts from the death benefit. So let's say you had $1 million in death benefit and you had $900,000 in cash value. If you had $100,000 out at that time, your $100,000 would be subtracted from the million and you would get $900,000 worth of death benefit. All while, even while you had that loan out, your cash value was never affected. It's just the loan would change what the death benefit is at the time. And the next one is, isn't this just whole life? So yes, it is, but it isn't. There's a lot of different types of whole life. And the more and more I go into this, there's normal whole life where you don't have a increasing death benefit. It's not just normal whole life insurance. What we're doing is we're using the whole life insurance chassis in order to do something that we want it to do, which is creating a bank. The next one is, isn't whole life more expensive? So we need to reframe the way we're looking at that, because whole life insurance, the way we're using it, we're stripping out the majority of the insurance portion and we're using it more as just a vehicle to hold cash, like a savings account. So while yes, whole life can be expensive, you get to determine how much that you put into the policy. So you actually get to dictate how much is actually going into it. So for some people it's less, some people it's more. It really just depends on what your situation is. The next one is, how soon can I start borrowing? Typically, insurance carriers, it has to be 30 days. But when you're looking at this type of stuff, again, we have to look long term, typically 5 to 10 years down the road, where we can start to understand how the cash value is going to build over time. But there are some people that do high paid up additions and then very, very low bases because they do need the money quickly. So for that, typically it's within 30 days. It does change depending on the insurance carrier, but a lot of carriers it's going to be 30 days before you can start borrowing from that cash value, even if it is a small amount you would be able to. So infinite banking is about creating financial control and leveraging your money smartly and building a legacy for the future. If you're ready to start your personal banking system, or if you want to know that infinite banking is right for you, let's connect. Drop your questions and comments or reach out to me directly, and I'll see you guys next week.